when when we reach sort of what is the new normal. It's so uncertain, but it could be a good number of millions of people, I think, in many estimates. But I'd say you're so early in the process. For example, people are going back and looking at other significant changes in the economy, and they've seen how many people go back when, for example, there's technological change and things like that. You may have seen some of this research, and you come up with an estimate. It's just going to be very hard to say. But my assumption is that there will be a significant chunk well into the millions. I don't want to give you a number because it's going to be a guess, but well into the millions of people who don't get to go back to their old job, and in fact, there may not be a job in that industry for them for some time. There will eventually be, but it could be some years before we get back to those people finding jobs. I mean, when people lose a job, if they can find a job in their own industry, that's usually the fastest way, is they know other people in that industry, different kinds of jobs. That's usually the fastest. If you have to go to a different industry and start over again, it's much harder, and that's where you start to lose people who are just fall out of the labor force, and it's very tough on their lives. We all know people to whom that happened in the global financial crisis, and hence our desire to do what we can to support this and support this recovery with the tools that we have.
Mr. Chairman, Michael McKee from Bloomberg Radio and Television. Based on what you were just saying about keeping policy accommodative for a very long time into the recovery, lower for longer, as far out as 3 years in your latest projections, is that basically it for the Fed? In other words, since interest rates are your main tool, the things you can do would push down on interest rates. But is it the case now that the only additional stimulus that can come to the economy is from the fiscal side?
Well, no, I wouldn't. I certainly would not say that we're out of ammo. Not at all. So, first of all, we do have lots of tools. We've got the lending tools, we've got the balance sheet, and we've got further forward guidance. So there's still plenty more that we can do. We do think that our rate policy stance is an appropriate one to support the economy. We think it's powerful, and as I mentioned, this is the kind of guidance that will provide support for the economy over time. The idea being that policy will remain highly accommodative until the recovery is well along, really very close to our goals, and then will remain accommodative even after we lift off. So I think that's a really strong place for rate policy to be. But again, we have the other margins that we can still use. So no, certainly we're not out of ammo.
If I could follow up, in terms of the balance sheet, are you concerned that your actions are more likely to produce asset price inflation than goods and services inflation? In other words, are you risking a bubble on Wall Street?
So of course we monitor financial conditions very carefully. These are not new questions. These were questions that were very much in the air a decade ago and more when the Fed first started doing QE. And I would say if you look at the long experience of the 10-year, 8-month expansion, the longest in our recorded history, it included an awful lot of quantitative easing and low rates for 7 years. And I would say it was notable for the lack of the emergence of some sort of a financial bubble, a housing bubble, or some kind of a bubble, the popping of which could threaten the expansion. That didn't happen. And frankly, it hasn't really happened around the world since then. That doesn't mean that it won't happen, of course it's something that we monitor carefully. After the financial crisis, we started a whole division of the Fed to focus on financial stability. We look at it from every perspective. The FOMC gets briefed on a quarterly basis. At the board here, we talk about it more or less on an ongoing basis. So it is something we monitor, but I don't know that the connection between asset purchases and financial stability is a particularly tight one. So, but again, we won't be just assuming that. We'll be checking carefully as we go. And by the way, the kinds of tools that we would use to address those sorts of things are not really monetary policy. It would be more tools that strengthen the financial system.
Welcome to the Crypto Teacher. Guys, I come back with that second video just to make you think. Now, basically, guys, we see the Fed. You all know I talk about the Fed all the time. And basically, this time, guys, it said that they're going to keep rates close to zero until 2023. Now, guys, the next time they meet is November 4th and 5th. Of course, that is after the election. Of course, everything is planned out, and that is for a reason. Now, guys, these are projections. They are not going to keep rates at zero until 2023, and I'm going to let you know that right now. They have to keep this market steady until when? After the election, and then come 2021, the Fed is going to change their whole tune. Now, why is the Fed going to change the whole tune, guys? Because we know the whole stock market is fake. They've been buying everything. We know there is no earnings. You go into these 10K reports, not one earning whatsoever, guys. We know this. They pump these stocks and they don't have, look at Nikola, the truck company, the electric truck company. No truck, but $1 billion company. Come on, guys. The Fed has to put the money somewhere. And of course, they're going to pull that money back. Now, we had Blackstone say that, that it's going to be a hit for 10 years. And we see this. We clearly know. We know this, guys. Now, basically, we have pensions that need interest. Of course, pensions are bankrupt. Pensions are gone. Now, we have the states now are bankrupt because all of this unemployment due to the C word. So we have evictions, foreclosures, and massive unemployment coming. Now, we know that they're going to push this C word until what? Until they're done moving us over to this digital economy. But guys, we have millions and millions of people that are not going to go back to work. They're just not. They're going to fall out the system. It's not going to be jobs for them because we know, because we into technology and crypto, we know that all this data and algorithms, AI is going to replace majority of these jobs. So we've already heard Andrew Yang say his Silicon buddies have already worked out. I've done plenty of videos on that. No truck drivers, no retail workers, no fast food workers, no telemarketers. None of that. It's going to be all gone. And what happens with small business? We see all the small mom and pops are closed right now. And the fact that trickles down to the economy. The only thing that's been holding this up is the Fed giving out free money, those stimulus checks. Just think about it, guys. If they had not given out that free money for that period of time, and that's the reason why it's taking them so long to come back with the other stimulus money. Because they knew the only reason why they wanted that is to get this digital economy moving and to get the repo market under control. That's the reason why you haven't even heard them of another stimulus check. But the fact is that once they do get that stimulus, that's the last. That's the end. And remember I told you, March or April, that's when everything ends. And Jerome said they're comfortable with the asset purchases that they made. What does that mean? They're going to stop. It's over. They're going to stop buying. And when they stop buying, it's going to do a ripple effect through the economy. But I just want to make sure we understand this. Like I said, I'm going to go back to this, guys. I know y'all get upset with me with this. Is that we must educate our friends and family. Whether we understand it or not, we all get affected. We saw this. If the C word didn't bring this into mind, the C word, all the mom and pops were closed, but Walmart, Lowe's, all these big companies can stay open. I mean, when you're supposed to be, the big companies making immune when it was way more people in there, you seem like to me you would want more mom and pops open because there's less people in different places. But the fact is, guys, we know this is all orchestrated, all planned. Now, guys, Jerome said that he was not out of ammo. Is this correct, guys? No, it is not correct. He is out of ammo. We have the funds rate at zero. We have interest rates at zero. We have the yield curve as flat as it can get. They're out of ammo, guys. But the fact is, they're at the finish line. We only have, 40-some days until the election. So what do, guys? They cause the problem, wait for the reaction, and they run in with the solution. And what is that solution? That's right, crypto, Bitcoin, altcoins. Y'all have a wonderful day, and remember, educate the family.